All right, good morning, everybody. Great to be here with you today, and great to be with you, Wyatt. I'm with Wyatt Lonergan from Van Eck Ventures, and we're going to talk to you guys today about the rise of stablecoins. Often this might be seen as maybe a little bit of a slower topic, but actually today this is one of the most fascinating topics I think that's at the conference, given recent legislation out of Washington, the Genius Act, which we'll get into. But Wyatt, do you want to introduce yourself to the audience and then we'll get going?
Yeah, very happy to be here. Thank you everyone for coming. My name is Wyatt. I'm a general partner at Van Eck Ventures. We raised a $40 million fund last year, really with a focus on kind of all things fintech on crypto rails. Prior to this, I was at Circle. I joined Circle through the acquisition of a company called Seed Invest in 2018. Kind of going way back, we attempted a lot of things at Circle, including tokenizing early stage startups, tokenizing public equities, real estate. We owned an exchange business. We ran payment APIs. All of these things kind of led us to USDC. And then in 2021, my partner Juan and I, who's also with me here at Van Eck, launched Circle Ventures. And during our time there, we invested in over 80 companies, from the underlying blockchains to wallets, DeFi protocols, payments companies, and about 15 leading venture funds. So it gave us a great perspective on the overall ecosystem and really kind of helped shape our investment thesis. We met the amazing team at Van Eck, and at this point, they pretty much had the full spectrum covered, from exchange-traded funds. The firm was the first to file for the Bitcoin spot ETF in 2017, to a great research desk run by Matt Siegel. Pranav, who was up here earlier, runs our liquid fund. And so the kind of final missing piece was to back early stage entrepreneurs, which is why we launched this fund. But it's interesting, we've kind of taken a lot of learnings from our time at Circle in terms of where we think the value accrual will settle around stablecoins, but also have this really unique vantage point sitting within a $130 billion asset management firm on how stablecoins will be broadly applicable in the real world. And so those two intersections are kind of what shapes our investment thesis.
Well, you've had your fingerprints all over this industry. This is going to be a fun talk. Just for me, I'm John Devine from BlockFills. We're actually local here in Chicago. We are an industry-leading market maker and liquidity provider. I'm also the author of a book called Bitcoin Options. And
Buy the book.
Thank you. And I have a few copies. If anyone's particularly interested in Bitcoin options, come find me and let's talk markets. But let's get to stablecoins. And I think to set the stage, can you just give us the high level, what is a stablecoin and why are these things useful and interesting to our market?
Yeah, stablecoins are very simple. It's just digital cash. If you're familiar with money market funds, they're basically just like tokenized money market funds. Let's use the case of Circle and USDC. For every one USDC, you can always redeem that at Circle for $1. Roughly 85% of that sits in BlackRock and short-term T-bills. Cash is managed, or the 15% cash is managed between JP Morgan and BNY Mellon. It's audited by Deloitte. That model is effectively what is now required through the Genius Act. In addition to, depending on the size of the stablecoin issuer, you're either going to be state regulated, or in the case of Circle, you're going to be federally regulated by the OCC. And then, the CEO or CFO has to attest to that on a monthly basis, or quarterly basis, excuse me. So stablecoins are a very simple product. They were initially developed, and one of the reasons we created USDC at Circle was really for trading purposes initially, which is quite funny. It eventually has evolved into this global rail for all things, all value that sits on chain. Jeremy Miller actually had a great quote where he kind of used this analogy of, like, we have voice over internet protocol, like crypto is kind of value over internet protocol, of which now you have this dollar that can sit on top of all these different financial institutions and plug into them. And so it can plug into all these different blockchains. It can then plug into all these different payment systems. But it's one rail, which is really unique because if you look at different types of payment options today, ACH, wires, even traditionally publicly traded assets, they all have their own clearing houses. That could emerge on top of blockchains, but it's still the same rail, which is really fascinating. So that's why it's so hard sometimes to parse the data of, like, how big is payments within stablecoins, which are probably going to settle somewhere in like the $40 trillion range this year. So it's astronomical. But I think if you kind of break down the data, like it's probably still 1% of DTCC volumes, still probably 1% of Visa volumes. But it's fascinating because for the first time we have like one rail versus thinking about it as like completely distinct systems. And it's programmable. It's anybody can plug into this kind of financial superhighway. A lot of the work I think that's being done today is around kind of the on-off ramps and trying to get this to plug into legacy financial systems. The Genius Act, I think, expedites that process greatly.
Yeah, I do want to talk about the Genius Act in a moment, which is extremely important for this topic. But do you want to talk just a little bit more on the programmability of stablecoins and why that just makes this extremely compelling relative to traditional dollars?
Yeah, I mean, if you think about like how it would previously work to build a fintech app, where you'd have to go, and I think this is actually very applicable in crypto. Like just 2 years ago, it was like a core advantage for a company to have like banking relationships. Like that's crazy. If you apply that to kind of, outside of the United States, the more hops you have, the more expensive it's going to be for a user, the more that it's likely that a business wouldn't want to serve that user because it's just too expensive to run rails into that country, or if they do, they have to pay fees. So now anyone with an internet connection and a wallet can get access to US dollar banking, basically. And from there, these are pieces of code. Developers can build that into unique apps, whether it be for, peer-to-peer payments, for B2B payments. And this does not include compliance. I think some of the smartest founders in the space are building legacy compliance rails into these products. And then that can go into different types of financial products around, earning, or investing. And I think increasingly we're seeing these two worlds of like, if you play that same analogy of like we're exporting the US dollar, we're now starting to export the US financial system because now we're going to be bringing traditional assets on chain. We're going to be creating net new assets that were maybe previously hard to access, like real estate or private credit. And, it's kind of like publishing these assets and immediately getting like Instagram or YouTube scale. Like anybody with an internet connection, a wallet can ideally begin to access this. But at the heart of it, they're always redeemed back for stablecoin. They're always bought with a stablecoin. So that's why you have this race today as well to kind of become the digital dollar standard, because whoever, right now it's basically Circle and Tether, many more will come into play. Whoever gets that, you're always going to be that source of liquidity. You're always going to go swap back to USDC or swap back to USDT, or you're going to pay with these assets. So in many ways, if you think about like protocol standards that we have that are deeply embedded in the internet, the same thing's happening right now for money, which is a really fascinating battle.
It's extremely fascinating. I think from my perspective, the disruption here is so interesting from just the accessibility perspective. And what I mean by that is, the crypto industry as a whole was under threat, being threatened to have bank accounts closed, or regulators were picking winners and losers based on which companies could get access to banking rails. We obviously saw stuff up in Canada that made a lot of us pretty angry at the ability for people to stand in the way of banking access. And so stablecoins seemingly are going to be competition to our traditional structures, and that's going to open up rails for a lot more people. So that's extremely promising to hear. Let's talk about the Genius Act. This is legislation that just got signed by President Trump just this month. I don't know, 10 days ago, something like that.
Very recently.
Do you want to start high level on the Genius Act and how this is going to be impacting both builders and end users?
Yeah, sure. I mean, I think I wouldn't say there's really many novel things that came out of the Genius Act that like we thought wouldn't be in there. I would say in terms of the model, what I discussed earlier, what Circle looks like or Paxos, that is kind of the new reserve requirement. They're going to be regulated. That's a great thing. There's a clause in there about like you can't share yield. So today, a lot of the stablecoin issuers monetize off the float, meaning that money that Circle keeps in BlackRock, they keep a bunch of that for themselves. They share with certain partners like Coinbase and Binance. I'll touch on that in a second because I think that's a very important evolution of the business model of stablecoins. Meanwhile, Tether keeps a lot of it themselves, or all of it themselves. So it says in there you can't share yield direct with the customer. This to me is like, if you go look back at the history of money market funds, like it's the exact same thing. The banks freaked out. Reg Q and interest rate caps happened. money market funds are like so boring and bland that no one cares. And like a bunch of that stuff was rolled back. So it was it reminds me a lot of stablecoins. But there's ways around it. Coinbase is going to call it rewards. People will find interesting ways. The yield is going to float directly to the consumer. So that was kind of a big piece. The second part is that big tech is basically cut out from becoming issuers themselves, and so they're going to partner. So how this relates to the business models, I think the float-based monetizing off the net interest margin like probably goes very, very close to zero. Tether, Paulo said yesterday that like Tether's thinking about coming to the US. They want to be fully regulated as a domestic issuer and a foreign issuer under the Genius Act, which means Tether is going to have to like, probably fully clean up. I don't know what their plans are, but my guess is, maybe a cap table cleanup, Cantor becomes a major investor, and they're going after the US market. That probably also means a lot of their advantages around scaling offshore start to go away because they have to compete, toe to toe. But that's great. Trump created like a clean slate for everyone to now go compete. But speaking on experience, everyone comes to Circle and puts their hand out and says, like, I'm your distributor, you have to pay us. They're going to do the same thing to Tether. They're going to do the same thing to everybody. And so the biggest players will be able to command maybe 80, 90% of that net interest margin, leaving a very small amount with the issuers. It's not necessarily a bad thing, because if you are Circle, for example, and I think this is why the stock has been popping so much, it's like there's a very high likelihood that they get Uber and Amazon. They just hired the ex-CEO of AWS to become a board member. Like, they're going to go after big tech, and they're going to decrease their margins, but they're going to increase, the scale of the network and the utility behind it. So those are positive things. Again, how does that flow back to an end user? I think that, anyone within that network, if you're an Uber, you get like cash back, right? And it'll be probably somewhat incentivized by that stablecoin issuer. But those are the core pieces. But I think going forward, it looks like the stage has been set initially, where you have kind of on one side these non-bank stablecoin issuers. I think they're going to partner a lot with big tech, and then you're going to have the banks. And it's unclear how the banks are going to get involved. We did make an investment, which is publicly announced, at a company called Ubix, which is a clearinghouse for stablecoins, and uses interchange, which is a legacy model on how you can incentivize banks to accept stablecoins at par value, to basically make them, digital cash equivalents, which is also very important from an accounting perspective. So both sides of that, kind of the tech world and the banking world, are now colliding. And yeah, it's only been like a week, so time will tell, but some very fascinating narratives that are happening.
You talk about the race that's really just begun to be the gold standard for stablecoin issuance. How do stablecoin providers find edge in that race? What's going to be the ultimate determining factor in who really captures this market, and maybe expand on that?
I think it's distribution. It all comes down, and it sounds so obvious, but it's distribution. And I think part of that is going to be distribution plus like what part of the tech stack do you really want to monetize on? So, Circle has some interesting things around CCTP and their developer experience, just like make it really simple for you to integrate USDC. You don't have to think about the chains. Like, they own that entire infrastructure. You can sponsor gasless transactions. You can do a lot of things that like feels like if you go on Robinhood, like that's the UX that I think founders need to build for. And Circle, and there's a whole host of developer platforms that are building that today. That's why Stripe went after Privy and Bridge. It's like they realized that the float is probably something that they can use as a CAC tool. It's not the underlying business model, but if they own the wallets and the payment APIs, they've got a phenomenal transaction-based business. And Stripe isn't a prime example to kind of verticalize that stack, which I think most issuers will start to go towards. Like, you can't just issue $1 because, again, somebody else will always try to outcompete you on price, pushing your margins down lower and lower. So you're gonna have to go offer other services. So my guess is like common themes you'll start to see pop up, or we're invested in a company called Agora. Agora is doing white labeled stablecoins. So they're running the compliance engine on the back, which I think is super important because it's non-trivial to be regulated federally, for example. Those companies will then start to offer things like wallets, like payment APIs. And so Stripe, Circle, Agora, like everybody's on a collision course. I think Tether, if Tether comes on shore, like they're part of that. So it's going to be like, how can you go attract businesses, developers? And I think there's going to be a little bit of a fragmentation in terms of who they all go after, because Stripe today is like very focused on that developer cohort. I think Circle, my guess would be more focused on kind of big tech. There's been rumors about like Alibaba integrating with them, things like that. Tether with Cantor will probably go after like asset managers and kind of more TradFi folks. So yeah, it'll be interesting, but I think the model that I see going forward is whoever builds distribution can look backwards and say, okay, what part of the stack do I actually want to own? And we've seen this all the time already, but that could be the underlying blockchain. So I want more control. Coinbase has Base, Robinhood has Robinhood Chain. You're going to see more corporates start to do this. I want to have my own stablecoin. All right, do I partner or do I become a direct issuer is the question there. Wallets, do I want to own my own wallet stack or do I want to go buy it from somebody else? But I think the trend is clear, which is the previous way of running a stablecoin company and keeping all the interest for yourself, that goes away. And you're going to have to go monetize elsewhere.
Yeah, I follow that. Now, thinking about stablecoins on a global reach and how stablecoin technology is going to help populations around the world that have not had smooth traditional access into U.S. financial markets, how does the stablecoin rail open up U.S. financial markets for these types of populations and tokenized stocks? So there's like a parallel there.
Yeah, I think this is like what the most profound part of stablecoins are, is that like anybody with an internet connection now can get access to the US dollar and to our financial system. And that's pretty profound. Like you can have an incredible impact on people's lives. And I think for these new financial institutions that are popping up are digital first, right? They're not putting and they're non-bank financial institutions. And so this is where I think the worlds of like stablecoins, DeFi and tokenized assets combine, because now in a non-custodial format, I can offer somebody $1 savings. I can offer them a tokenized money market fund. I can offer them access to Mag 7 stocks or whatever stock they potentially want, in addition to crypto assets. And so I think it's an evolution of the casino model. I don't think the crypto casino ever goes away. It's fun. It's a great tool. The internet followed a very similar trajectory, and then a lot of it was very speculative and casino-esque in the early days. And it's evolved to where we are today, where pretty much the entire economy globally runs on the internet. These are just kind of the financial rails that I think the next wave of global participants will use in just a way that they don't have to ask for permission from a bank to do that. But I do think there are a lot of regulatory implications. It's funny, I was talking to a founder the other day, and if you're here in the United States, like Trump and everybody just talks about like exporting the US dollar. A lot of countries are worried about that. A lot of regulators are worried about that. So like we're screaming it loudly. They're the ones who I think could start to potentially shut off access to stablecoins with their main concerns around capital flight. However, there is a really interesting business proposition for them, which is these markets already exist. Sure. They exist in cash form. And so now there's ways to actually like tax this, to have it be part of the actual economy. If there's demand for it, people want it. But they could enable restrictions on capital flight. So that's going to be a challenging part for crypto, is like how do you still reach these users without governments trying to block it, just given how integrated crypto now is to the internet, through exchanges, through the app store. It's not as kind of like off the grid as it used to be.
This is a thread that I almost want to go one more minute on it or 30 more seconds on it. Stable coins, the reason this stuff, from my perspective, it's getting through Congress and getting signed, because this is really a tailwind for the US dollar to continue its world reserve currency status. And, in the face of all these headlines we're reading about, threats to that. So based on stablecoins allowing access to US dollar markets, do you think other countries around the world, Asia, Africa, Central and South America, are they really just going to allow this stuff to seamlessly flow into those jurisdictions? Or is there going to be some major pushback on the accessibility of these instruments, maybe even for those who most need them?
It's a great question. I would not be surprised if there's pushback in the future. But the difficult thing about crypto is, right, that like even if you buy Bitcoin, there's always a way to get back into stablecoins. So it's a really hard thing. We live in this VPN economy now that it's just very hard to restrict access to these things. And again, if they do, they know that it will go back into these kind of black and gray markets around cash. And what I find so interesting is like when you go to some of these countries, stablecoins are the premium product. They cost the most. You can get different types of dollars, and stablecoins are the highest value dollar. And why are they the highest value dollar? Because it's not cash that you stuff under your mattress. It's digital cash that you can lock onto your phone and potentially access somewhere else. So it is like true financial sovereignty, and it offers real portability. If you extend that to all different types of assets, like that's where it gets really, really powerful, right? Like now I own these stocks, I have a claim to them, but I can choose where I want to hold it. So I think that's, potentially threatening for some jurisdictions in the world and how those countries operate. But it's a threat because it's a fundamentally better product. Ultimately, it's also a threat for a lot of financial institutions. I mean, I think, I expect a certain level of UX, and when you go on your traditional brokerage firms, like they're god awful. And when you tokenize these things, that means like I have the capability to move that to a different platform. And I think the leaders in fintech today, the Vlads from Robinhood, understand that. And they're going to deliver the best customer experience, and they're going to give you the option of portability. But you're not going to want to leave their platform because it's so damn good. So that's another kind of threatening angle. Is like, yes, we want to promote this, but you're going to see complaints from banks, from asset management firms, all sorts. Like Citadel just wrote a letter to the SEC on tokenized stocks. Like, these things are a threat to a lot of incumbents. So it's an interesting. I think the next Trump's time in office, I think there's just going to be intense competition around this, which will probably set the stage for whoever the next president to come up and try to, firm up the rules.
Does that impact your investment thesis? Just kind of realizing that we are in a political cycle, so to speak, around these assets and this technology and this industry as a whole. Quite frankly, does that come into play when you're deploying capital, or how do you think about the political cycles that we deal with here?
Yeah, and it looks like this is the last question we have to answer. It does. Our focus has always been on founders that can, think about and understand compliance, but still build solutions that can be globally accessible. And so I think, coming into this cycle that's different is that we now have the Genius Act. We're going to get the Clarity Act. Hester Pierce already wrote that like we love innovation, but securities laws aren't going to change. So now you need to think about how these new rules come into effect. And I think the best founders are not the ones that are trying to run offshore and build. They're the ones that are trying to be in the United States, work within the rules. And also, I think some of the teams we've had the pleasure to partner with are really going to the SEC and the crypto task force and promoting new ideas that are still within the rules, and showing them how our laws and some of these regulations can evolve over time through the use of this technology. And I think a lot about things like transfer agents, or if you kind of look at how these systems and dating back to Securities Act in 1933 and history, we wanted to design systems that looked a lot like blockchains. We just didn't have the technology. Now we do. And so I hope that as we continue to use this and scale this industry, that the laws change in accordance, because the technology just shows that it's so robust. So we can't really think about what's going to happen next with the next president. My hope is that we've just done a great job and shown how powerful the technology is, that we ultimately get what we want. So
that's very well said. Well, Wyatt, thank you. Anyone who wants to come talk to Wyatt, he's around here. Me too. Thank you all.
Appreciate it.